We are looking at a $1.5 billion asset that has never generated a single dollar of sales. Trading at $32.76 a share, ArriVent BioPharma carries a total market capitalization of $1.52 billion. Look at the trailing 12-month data on a standard terminal dashboard, and the numbers are severe. $0 in revenue, a net income of negative $145.2 million. Strict historical frameworks struggle to reconcile these numbers. To find a justification for the current market price, an analyst has to move away from retrospective accounting and toward a probabilistic model. For a serious analyst, this contradiction forces a specific question. Is the market purely speculating, or is it efficiently pricing a future reality that traditional metrics cannot see? ArriVent BioPharma operates as an oncology-focused clinical-stage biopharmaceutical company. The bulk of the company's value is tied to its lead asset, furmonertinib. This drug is in global Phase 3 trials, the ArriVent study, targeting a specific mutation in non-small cell lung cancer, neutralizing the irregular cell receptor. They do maintain a secondary pipeline, primarily consisting of novel antibody-drug conjugates, but these are in much earlier stages of development. The critical catalyst for the company is the Phase 3 data readout expected in mid-2026. That data will dictate whether furmonertinib can secure FDA approval. This situation creates a strict binary outcome. The entire $1.5 billion market cap rests almost exclusively on the clinical and regulatory success of that single lead asset. To see exactly where these traditional frameworks reach their limit, we can run ArriVent through the fundamental lens of Warren Buffett, who prioritizes economic moats and honor earnings. Evaluating the moat, ArriVent holds exclusive global rights to furmonertinib outside of Greater China. However, it faces immense, well-capitalized competition from established pharmaceutical giants like Johnson & Johnson. Moving to Buffett's financial checklist, ArriVent has a negative return on equity and deeply negative owner earnings. The only positive metric is a highly manageable net debt-to-equity ratio of negative 22%, backed by a strong cash position. Based on existing cash flows, Buffett's verdict is a hard pass. There is zero margin of safety. We get a similar result if we pivot to the godfather of value investing, Benjamin Graham, and his defensive investor checklist. This graphic shows Graham's classic intrinsic value formula, the square root of 22.5 multiplied by earnings per share multiplied by book value per share. When we input ArriVent's projected 2026 earnings per share of negative $4.05 and a book value of $7.86, the math collapses. You cannot calculate the square root of a negative number. Graham's ultimate failsafe is the net current asset value. ArriVent holds $348 million in current assets against just $25 million in liabilities, yielding a liquidation value of roughly $7.17 per share. This exposes the limitation of historical value investing. Graham and Buffett demand a margin of safety derived from past earnings or current liquidation value. Their frameworks completely ignore the financial impact of a future clinical success. Peter Lynch offers a different framework. He accommodated companies without current earnings, provided they fit into specific narrative categories. Under Lynch's system, ArriVent classifies as an asset play. The company holds a massive cash runway of $326.4 million, which is highly controlled and capable of funding operations through the fourth quarter of 2027. Lynch often relied on the PEG ratio, price to earnings growth, but that metric is inapplicable here, despite the company projecting an infinite forward growth trajectory from $0 to $42.1 million in 2027 sales. Instead, we look at a different Lynch indicator, exceptionally low institutional ownership. Currently, institutions hold just 9.48% of the float. However, that is changing. Over the last 12 months, 67 institutional buyers have infused $145.25 million into the stock. Lynch would classify this as a speculative buy under one strict condition. The investor must possess specialized medical knowledge, indicating that the upcoming Phase 3 data will beat market expectations. Without retrospective earnings, the only valid tool for valuing a pre-revenue biotech is a discounted cash flow, or DCF model. This requires synthesizing 2027 revenue guidance with peak sales assumptions. Our base case assumptions for this DCF include FDA approval, a 10-year forecast period, and peak risk-adjusted sales hitting $450 million by 2032. To discount the risk of this binary clinical trial, we apply a 2% terminal growth rate and a high weighted average cost of capital of 13%. This sensitivity matrix plots terminal growth against the cost of capital. In the center, applying our 13% discount rate and 2% terminal growth, we arrive at a base case fair value of $38.50 per share. If we apply an optimistic scenario, dropping the cost of capital to 11% and raising terminal growth to 3%, the value jumps to $48.20. Conversely, in a pessimistic scenario with a 15% cost of capital and 1% terminal growth, the fair value drops to $29.10. We can also use a comparable price-to-sales model for near-term relative metrics. Applying the biotechnology sector average multiple of 4.1 to projected 2027 sales yields a bleak $3.80 per share. To understand what the current $1.52 billion market cap actually implies, we have to run a reverse DCF. The reverse DCF reframes the valuation as a specific medical probability, whether $850 million in peak sales is a realistic expectation based on the clinical data. This math forces the analyst to shift focus away from what the company is worth today and toward the probability of those specific clinical outcomes. The synthesis matrix summarizes our outputs: liquidation value at $7.17, comparable sales at $3.80, current price at $32.76, and our DCF base at $38.50. Strengths include a $326 million runway and 9.48% institutional ownership, countered by Phase 3 risks and Johnson & Johnson dominance. Evaluating the data across these frameworks, the final investment opinion is a hold. Different investor classes have distinct buy triggers here. Liquidation value purists would step in at $7.17, while DCF modelers requiring a 20% margin of safety would target $30.80. In clinical stage biotech, historical value provides no guidance. True value exists in the disciplined modeling of probabilistic futures.